Okay, so let's continue then with repairs and maintenance. So the repairs and maintenance, what you have to look out for, is there anything that could potentially be an improvement? Okay, so they tell you the factory and office buildings needed extensive repairs and maintenance, and the following amounts were spent on 30 June. So they replaced damaged carpet with ceramic tiles. They painted the factory and office building. Then they erected 50 new carports, and that is including that, and they replaced the old diamond mesh with a palisade. Now, based on that information, numbers 1, 2, and 3, 4, is where something was in a bad condition, and we've just replaced it and made it new. So those items are all deductible. Because we're not creating anything new, we are just replacing what is already there, but that is not in a good condition any longer. A new carport, however, is an improvement. That is something that is new, and that will not be included in your taxable income. However, when we work out the capital allowance for that carport, we will use the amount excluding of that. So you can get a capital allowance for that, for the amount exclusive of that. Okay, so that is what you had to see from that information. Okay, then the next one was Machine Benji. So Machine Benji was totally destroyed due to a technical error. Okay, now as soon as something is destroyed, it is potentially capital gains. Okay, because of the fact that the destruction thereof is seen as a disposal. And it was scrapped on the 15th of June. It was purchased second-hand and brought into use on 10 March 2018 and had a cost price of $385,000. Okay, now because of the fact that they don't tell you it was second-hand and purchased from a non-vendor, we do not have notional input VAT on this item. Okay. They need to specifically tell you it's second hand and it's from a non-vendor before you can claim notional input VAT. Otherwise, you take the amount as is. And then they tell you the insurance company settled the claim on the 8th of July and the indemnity payment amounted to $400,000. Now that indemnity payment, like we said previously, is the proceeds for that specific item. Now, because of the fact that that machine would have had a capital allowance, we would also have to go work out if there's a recoupment or potentially a scrapping allowance that we need to deduct for this item. Okay, and that would be based on what the proceeds are, but it would be kept at the original cost. Now, in this scenario, the original cost was less than the proceeds, so we would use the $385,000 to work out the recoupment, and then we would adjust both the proceeds amount and the base cost for the capital gain calculation. Do you have a question? Are you just thinking?
Yes, I'm just thinking, but I just want you to put it in writing so that I can understand.
Okay. Let me share the Excel file and then I'll start the question on the board. It's a bit bad that this thing doesn't want to project properly today. Okay, so let's do the first 2 points and then we'll move on to the next bit. Okay, so I told you your starting point for this would be what is the net profit that they have given to you. So you start with the net profit amount as your first line item in your taxable calc. calculation. Okay. So because they don't give you all the other income and all the other expenses, you start with the net profit amount. And then based on the additional information, you add or subtract things from that value. Okay. So if they give you net profit, that is where you start, and then you do the additional adjustments for tax purposes. So in this scenario, it was 2.5,666,350. Thank you. Okay, so that is the first thing. Then the second one is our repairs and maintenance. Okay, now what I want you to do when you have repairs and maintenance in a question, I want you to go list all the items specifically for those repairs and maintenance to make sure that if you make a mistake on one of them, you don't lose the marks on anything else. Or you show them separately in your calculation so that I can at least mark them. Okay. Now the first one is, I'm just going to say replace the carpets. So for that one, the amount was 53,600. You can deduct that. Okay? Then the next one was your painting of your buildings. And that value was 28,720. Okay, then we erected the new carport. So your new carports, here you would show it a 0 because it is an improvement. So it is capital. Okay, so for that one, you show me it's a 0, you don't show the value for it. And then replacing the palisade, that amount was 48,300. Okay, now what we said for the new carport specifically, we would be able to claim wear and tear for your carports. Now, where will I find that information? That information was available at the end of the question that says the write-off period for your carports is 5 years. Okay, so there you know, for the carports, we get additional depreciation or wear and tear allowance. So we take that 38,900. Now I've told you, because of the fact that it's inclusive of VAT, we need to remove the VAT amount from this value. So I multiplied with 100 over 115 to get the amount exclusive of VAT. Okay, how many months have I had the carports for? I want you to count. How many months have we had the carports for? Okay, so 9 months. Okay, so the first step is we divide by the 5 years. Because it's over 5 years, you divide by 5 years. You do not multiply it with 5 years like you would do with the percentage. Then we multiply it with the 9 over 12. So this is how we apportion it. For only the period that we have used it. And that should give you a value of 5,074 rand. Yes. Sorry, it's one calculation that works like that. Now I need space there on the other side to write, so. Are you guys okay up to here? Okay, then if we move on to machine Benji, which was point number 2. I'm just going to continue here on this side. So the calculation then continues and goes up here. Okay, so this should be underneath that information. Okay, so for machine Benji, we know we get a capital allowance because it is used in our manufacturing. We would use the section 12C, which is that 40%, 20%, 20%, 20%. But because it wasn't a new or unused machine, we would actually apply the 20-20-20 over the 5 years because it was a used machine. Okay, now what you have to do here is step 1, you go work out what is the tax value. The reason you need to work out what the tax value is we need to see is there a recoupment amount, okay, for that, and as well as the capital allowance for that period. Okay, so the first step we do is we show what was the original cost. So the cost based on the information was 385,000. And I said we do not claim notional input VAT because of the fact that we haven't acquired it from a non-vendor. They need to specifically say it's second-hand and from a non-vendor before you can claim it. Okay, so we take that value for our allowances. Now we do not apportion the allowances. So let's quickly look at when we acquired it. So we bought it. Let's quickly see if it's on us. Okay, machine was destroyed, consequently scrapped. Steam was purchased 10 March 2018. Okay, so our year end runs from 1 March to Feb. So that means in 2018 we purchased it. So 2018 to 20. Okay, so this would be 2018, 2019, 2019 slash 2020, 2020 slash 2021. Okay, so we have it for 3 years already. We just look at the dates. Oh, sorry, right? I'm looking at the wrong question. Okay, so our year end is from 1 April to 31st of March. Okay, so that means 2018, 2019, 2020. Okay, so the first one would have been in 2018, 2019, 21, 2021. Okay. So because of the fact that it's a used item, it is at 20% for each of these years. Okay? Now, if you go work out 20%, you should get 77,000 per year. Okay. Now, in your calculation, you will include this amount for the current year as a deduction in that column. So let's just make the columns here so you can see where the calculation is. Okay, so the first thing is the wear and tear for the current year of 77,000. Now to work out the tax value prior to us disposing of it, you should get to a value of 77,000. So that there's 1 year remaining that we can still deduct. Okay, now for the recoupment, we said that it was sold, or it's deemed to have been sold for 400,000. So it is deemed to be sold for 400,000. But the rules say can never recover more than the original cost. So that's why that 400,000 is limited to the 385,000. So I'm just going to say original cost. Okay? So that means we take the 385,000 and then we deduct the current tax value. So we deduct 77,000, which comes from there, from that 385,000, which is basically all of those deductions that we have already claimed, which gives you a value of 308,000 that we are actually recovering as the recoupment. Yes. Okay, so the 385 times 20%. Do you get that? Yes. Okay. Ask me if you lose me, then I can just explain. Okay. So the 77, just to repeat, is the 385,000 multiplied with the 20%, which is applicable for Section 12C allowance. Okay, but because of the fact that we've disposed of it, the next step we have to do, now we've worked out the recoupment. Now we have to go look at, is there any potential capital gain? How do we work out the capital gain? Step one, we start with the proceeds. Okay, so we know the proceeds was 400,000. Well, what do I adjust those proceeds based on the rules? Do I adjust that 400,000 with any amount? With the recoupment amount. So I reduce it with this 308,000 that I am already taxed on. Okay? So that I'm only taxed on the difference that is remaining. So that would be your 92,000. But for capital gains, we are allowed to deduct the base cost. Now the base cost is your original cost reduced by any recoupments. Okay, so our original cost for this asset was the 385,000. Okay, now how much have we recouped, or were we already taxed on? 308. So I reduce that base cost with that same amount, and that means my base cost that is left over should be 77,000, which is basically the tax paid. Okay? Now, to work out the gain, I take the proceeds and I deduct the base cost to work out the capital gain. And the capital gain for this is 15,000. Okay. Now this you would either show in a separate calculation or you would include that in a separate column, because when we work out the taxable capital gain, you have to aggregate all your gains. So we have to look at, is there any other gains that we need to add to this value before we add it at the end of our calculation. Okay, are we all okay up to here? Do you have a question?
And is it 385 minus 208 times 77? No, that's a bracket.
No, that's a bracket. It's just to show the calculation. So it's just to show how I got to the 77,000. So it's the 385 less the 308 gives you an amount of 77,000. Sorry, the space is a little tight here on the board. Okay, so let's continue with the, yes. Okay, I've left it there because I want to use the rest of the board. But normally you do a separate column from the one that you put the taxable income in.
So you don't include it in the calculation that you've been doing?
No, we're going to include it right at the end once we've looked at all the capital gains, all the capital losses. Okay, so that's why it's not pulled over yet. Okay, so then the next entry they talk about in your question on page 114 is machine Foxtrot. So they tell you an order was placed on 1 July 2020 with an Austrian supplier to replace the machine Benji. The cost price of the machine was 1.36 million. Air freight, customs and clearing costs amounted to 95,000, and the foundation for that machine that they had to build was 44,000. And then they tell you it was brought into use on 1 March 2021. Okay, so they actually only started using this machine in the beginning of March. Now, with the Section 12C rule, we do not apportion it, so it doesn't matter how long we've used it in that period. So even though we've only used it for a month, we get the full deduction. Now, because of this fact that this is a new machine that we've bought and brought in, we will apply 40% in year 1 and not 20%. Okay. So section 12C, we're going to apply 40% and there's no apportion. Okay. Now, those additional costs, you add it to your cost of your asset when working out this allowance. So I'm just going to read through this in the factory building and then we'll do the calculations next. Then the factory building, they tell you they've also experienced difficulty in meeting the demand as the factory could not produce sufficient amounts of stock to satisfy the customers. The directors therefore decided to sell the existing factory and use the proceeds to purchase a new factory. So they are selling the existing factory and they are buying a new factory. Now, normally if you sell an asset and you acquire a new one, you can defer that recoupment over the allowance. Okay, then the erection of the original factory, which was completed in March 2016, was 1.8 million and it was brought into use immediately. So that means the factory, we started depreciating it in 2016. Now this depreciation we do not apportion either. Then we sold it in April 2020 for 1.9 million. Now we are selling it for more than its original cost. So we know we are making a capital gain. Okay. The recoupment would depend on how much of that value have we already claimed as capital allowances. And then they tell you the new factory was purchased in May 2020 for 2.5 million and brought into use 18 June 2020. Okay. So what you had to see there is our factory allowance, which is section 13. And then we have our CGT based on the disposal. And we have our recoupment. Okay. Now, technically, based on the additional information they've given to you at the end, you do not need to defer the recoupment, but we have shown it that way so that you guys can see what it would look like. Okay. So that in the question they say you should ignore it, but we have done it as if you should do it, just so that you can see what it would look like in a question. Okay. Okay, so let me just share the Excel file here and then I'll explain to you guys on the board. Okay, so for the machine Foxtrot, because it is a new machine, should I just wipe that out and then continue there for you guys? Okay, so for the machine Foxtrot, because it is a new machine we are purchasing, we just have to work out what is the allowance we can deduct. Now, before we can work out the allowance, we have to work out what is the original cost. Now, our original cost is the 1.3 million, 1,360,000. Then you add the 95, which is your customs and clearing cost, because that is cost that you have to incur to bring that asset into the country. And then you also add the 44,500. Now, why do we add all of these values together? Because that is the physical cost that you had to incur to bring that asset into the country, into a condition and the location that you want it to be. Okay, so if you add all of this together, you should get to a value of 1,499,500. Okay, so this is the value that I am going to use to apply the Section 12C allowance. Now we said it is at 40% in year one because of the fact that this is a new asset. Okay, so if you apply 40% to that value, the deduction you are allowed to get for that machine is 599,800. Okay, so that is the deduction we get for it based on that. Now, with the section, we do not apportion it, so even though we've only used it for a month in that year, the full 40% is applied. Then the factory building. Okay, now the factory building, we know that one got disposed of. Okay, so the one was sold and then we acquired a new factory. So the first thing we have to do is we look at the old factory to work out, is there any additional capital allowances we can deduct, the recoupment and the capital gain, and then for the new building, only the capital allowance. Okay. So the cost of our old building was what? What was the cost of the old building? Okay, so 1.8 million. Okay. What allowance have we received for this building so far? Okay, what is the allowance for factory building? What percentage are we allowed to deduct per year? Okay, 5%. Okay, so it's for 5%. Now, that building was initially bought the first time or brought into erection in March 2016. So that means 2016 up to 2020, which is the year before ours, 2016, 2017, 2018, 2019, 2020 is 5 years. I'm just going to count you for 5 years worth of allowances for the previous years, which should give you a value of 450,000. Okay? But then for the current year, if I do that calculation, it is an additional 90,000. Now this 90,000 I can also claim in the current year as a deduction. Okay. Then our tax value based on this would be, we should get to an amount of 1.26 million, which is the tax base or the tax value. Okay. Now we know we sold it for 1.9 million, but because the 1.9 million is more than the 1.8, our recoupment, we write there for me that the 1.9 million is limited to the 1.8 million. So we apply the 1.8 million and we deduct the current tax base or tax value of 1.26 million to get to a recoupment value of what? 540, which is the sum of the 450 here at the top and the 90,000 there. Okay, so that is what our recoupment value is. But then we have a rule that you are allowed to defer specifically for the buildings. That's the one you need to know. Is we are allowed to defer this recoupment over the same period as we would have deducted these allowances. Now 5% is over 20 years. So what we will do is this recoupment, only 5% of that will be accounted for in the current year. Wait, let me just unhide here quickly.
What is the 90,000?
The what?
90,000.
Where are you now? This 90,000. It is the 1.5, the 1.8 million times 5%. You not get 90,000. Just quickly want to check something out. Okay, so how you can do the deferral of the recoupment either alone, separate, or you can deduct it from the cost of the new asset and then apportion it based on that for your allowances. Okay, so one of the two is allowed. Okay, so what would happen here is to defer this, we would take the 540,000, multiply with 5%, which should give me a value of $27,000. Okay, but now we still have the new machine, which we also have to work out a Section 13 allowance for. So the new building was purchased in May for 2.5 million and brought into use 18 June 2020. So in addition to this, we've got the new building, which is the 2.5 million times 5% gives us a value of How much do you get? How much? Okay, 125,000. So for the new building, we can then deduct 125,000. Now in the solution, you'll see what they've done is they've netted off these two to work out a net deduction. So you can either show them to me separately or you can combine them as one. Okay. It will work out exactly the same. But I prefer doing them separate because they're actually two different concepts. Okay, so that is the deferral of the recoupment for your building that you need to know. Make sure you know that. And then the allowance specifically. Okay, so I see we ran out of time now. So what I'll do is I'm going to upload this question for you guys on VC Learn, and then you can work through it. The rest of the things that are left over is pretty straightforward. It is things that we have discussed. The only portion that we haven't finished here is the capital allowance component, which would be the 1.9 million reduced by the recoupment amount of 540. And the base cost of 1.8 would also be reduced by that 540. And then that difference would be your capital allowance, would be your profit, which was 100,000, which you would then add to that 15,000 we previously calculated. Okay, so the rest of the things we have discussed in previous sessions, so that should be all right for you guys to work it out. If you've got any other questions, then you are welcome to just pop me an email. Okay.